All right, guys, December 22nd, the market has closed. It was pretty much mixed. The S&P was down slightly. Dow was down 0.6%, and the NASDAQ was up 0.5%. The biggest gainers and losers today, nothing. So I'm going to go over Paycom Software, I believe it's called, and Carmax. So Paycom Software, they do human resource software. So it's basically software for managing payrolls, HR departments, all that stuff. They're up 4.5% today. They're a $26 billion company. Ironically, the top three gainers today were all around $25 billion. Very high PE. So an X there, 165 PE. Remember, not any one metric makes or breaks a company. This is very high. It could be for multiple reasons, but either way, profit margin is over 10%, about 14%. So that's a good thing. No dividends. So let's go on to the financial statements. The annual revenue growth, very big revenue growth, 225 to 737 in the last 5 years. 10 years ago, they did 57 million. So everyone, I can already tell I'm willing to pay a much higher multiple of earnings and cash flow because of the growth potential here. They've tripled in the last 5 years. That's a huge growth number. Profit has gone from 21 million to 180 million. So even though their revenue has tripled, their profit's gone up 8.5 times or something like that. It's a huge jump. So check marks on revenue growth and profit growth. Shares outstanding, slightly higher. I figured it would actually be, I thought it'd be worse than this, but it is slightly higher, about 1 million shares more. It is an X, but not terrible. Balance sheet. So here's what we want to look at: cash on hand on the total current assets versus total current liabilities. So total current assets are 1.8 billion or so. Total current liabilities are 1.6 billion. So they slightly have more current liabilities, but the cool thing is their total long-term liabilities are very low. They almost have enough cash on hand to pay off all their long-term liabilities, which is a big plus. It just shows they have a lot of current liabilities versus current assets. So still a check mark. Now for the big one, cash flow growth over the last 5 years. So remember, cash flow is cash from operations less your capital expenditures. This is what companies use to pay dividends, buy back shares, pay their debt payments, things like that, to grow more of a company. Also to use the cash to grow, make acquisitions, things like that. So what we do is we add up the last 5 years of operating cash flow, then subtract the last 5 years of capital expenditures. Now remember, this is data that I get from Y-Charts, which costs me about $500 a month. I will be creating an application web app that we're doing right now that'll give you this data itself, plus the 8 pillars. Like and subscribe, obviously, to keep in track with that. And we do have a Patreon that you can sign up for, that as long as you're a Patreon member, you'll get the application and the web page for free. So again, I'm going to add up all 5 of these and give you an average over the last 5 years. So hang on a second. So guys, the last 5 years average free cash flow was 82 million a year. But in the last year, they did $130 million. So obviously it's trending upwards. So I am willing to pay a higher multiple of free cash flow. What's that number? Let's call it 25 times free cash flow. $2 billion. The company's currently at 26 billion. So it turns out the PE is probably pretty indicative of where the value of the company is. Now, a lot of people argue with me and say, no, it's growing a ton, it's growing a ton. Well, of course it is. But every investment is the present value of all the future cash flows. If it's growing a ton, you can pay more today. But it doesn't mean you pay whatever it takes to get the company today. I still think this is an overpriced company. I would hold off on buying it right now, especially with the economy the way it is. This company is going to be very responsive to the economy. Let's actually see how they've done the last 12 months in free cash flow. The last 12 months have been about the same, $130 million or so in free cash flow. So there's nothing that's really jumping out at me to say I can justify a really large premium, 10 times the 25 number. So they're actually selling for about 150 times their free cash flow number as well. And we like to find companies that are below 20 that have decent, moderate growth potential. So I do think that this company is something to look at. They have a great balance sheet. It appears to be a great balance sheet so far. But I think in terms of 165 times earnings, pump the brakes, wait for a better opportunity, just keep it on your radar, and wait for it to fall drastically in price so you can pick up shares on a growth company at a reasonable value. So then the next company we're going to look at is Carmax Kmx. So Carmax fell today. Let's see why they fell today. Why did they fall today? Third quarter results. Oh, they top views. Interesting. Earnings beat fails to offset lack of guidance. So they beat on earnings, but the guidance wasn't, they didn't have any guidance. Obviously, in the car business, people don't realize the car business's margins have not gotten much better in the last. I used to work in the car business 17 years ago, and the margins are pretty much the same as they were 17 years ago in terms of total dollars, not necessarily in terms of percentage. So it's kind of a tough business. I think as time goes on with the internet, it makes it harder and harder, lower margins. But if an economic downturn occurs, there'll be probably a lot of car dealerships and used car dealerships that fall to the wayside, increase the margins for the ones that are still around. So let's do our analysis on them. $15 billion market cap, 22 PE. So again, an X here. We want below 20, but not terribly off. Profit margin of 5.5%. Seems about right for a car company. But in the last 12 months, it has only been about 4%, not even 3.5%. So the last quarter was definitely better. And car business is a very tight business. The gross margin and bottom line profit margin are not going to be high. So 2 X's to start. Now, their quarter ended in February, right before the pandemic, and their revenues are definitely increasing over the last 5 years and over doubled in the last 10 years. So definitely a positive there. Net income, wow, pretty nice. $623 million, very consistently growing. Last year, $888 million. And number of shares outstanding, definitely decreasing. So we have 3 check marks in a row here. Revenue growth, profit growth, basic shares outstanding. Let's see how they've done in the last 12 months with the pandemic factored in. Not terrible. Revenue's only not even down 10% in the last 12 months, and they were still profitable. So pretty good numbers here. I'm pretty impressed with that. I'm pretty happy to see that. So that's just something to consider. Balance sheet. Now keep in mind, guys, total current assets of $4.3 billion. I want to make note. Their total inventories are $2.8 billion of that. That's a big number. Keep a little cautious on that one. They do have a lot of cash on hand, $700 million, but there was a lot of inventory there. The good news about the inventory is that they probably won't take if they had to be liquidated, they probably wouldn't take as big a hit on inventory here as they would other businesses. They'd probably take a 10 or 20% hit on inventory here, not a 50% hit. So that's a good sign. But either way, $4.3 billion in current assets. Current liabilities, wow, only $1.6 billion. Awesome. But long-term liabilities, there's a lot of long-term liabilities there. So you want to make sure a lot of this is probably leases for their space, but it's not up a lot in the last 10 years, even though the revenue is up a lot. Let me make sure I'm looking at quarterly. I'm sorry, kids. Oh, that's right. No, I'm fine with that. Quarterly is fine. Quarterly is good. It's the same thing, but the total lease obligation has increased slightly in the last 10 quarters. So keep that in mind. I'm sure a lot of it's leases as opposed to debt, which is essentially can be the same thing. Cash flow, the big mamma jamma. Now remember, oh boy, guys, this free cash flow is terrible. It's worse than it was 5 years ago, and it's negative over the last 5 years on average. So, wow. You have to figure out why they're spending so much money. I mean, they've always been spending. Have they ever had negative? They've never had a year of free cash flow in the last 10 years. Guys, I'm going to go ahead and say avoid this company. I like free cash flow. Free cash flow and net income should equate out over long periods of time. Here we have a lot of negative free cash flow, and we're still showing a positive income. That's kind of a weird thing. So I don't understand why that is. That's a very tricky situation. Maybe I'm not understanding this very well, but I think this is a pass for me. I'd rather buy. There's plenty of other $15 billion companies I can buy with more reliable free cash flow and more reliable future that I can understand. At the end of the day, cash is what pays your bills, and they've never had free cash flow in the last 10 years. That's a problem for me. So I'm going to pass on that one. So it's Tuesday. Thursday's their Christmas Eve. We're not going to have a recap that day. We're going to put another video out. But I appreciate your support. Have a great Christmas. Have a great New Year. And we will talk soon. Thanks a lot, guys.